Hello, everyone, and welcome. We're going to give it a couple more moments as more people log on and join us today. All right, as more people log on, welcome everyone. Good morning from the Northeastern United States. And to those of you joining us from around the world, good afternoon and good evening, and welcome to Columbia Business School Executive Education's informational webinar on their upcoming course, Value Investing Online. We're so happy that you joined us today. My name is Mark Linehan. I'm a webinar facilitator with Emeritus. Emeritus is thrilled and honored to be partnering with Columbia to be bringing you this course. As more people join today, as more people log on, I want to direct your attention before we get started to the bottom of your Zoom screen. You're going to see a box there that says chat. Has a little air bubble next to it. If you click on that chat box, that's an informal way that we can communicate with each other during this webinar and say hello. I've just posted a message there myself. And if you could make sure that it says to, and you can choose whether it's toggled to all panelists or all panelists and attendees, please make sure you choose that latter option, all panelists and attendees, and tell us your name and where you're logging in from today. We have Bradley from Nashville. Good morning, Bradley. And make sure that it's to all panelists and attendees when you say hello. We have Tom from Ithaca. Good morning. Scott from Kansas City. Steve from Providence. Varun from India. Good. Hello, hello. Sam from New York City. Hello, Jerry. Hello, Switzerland. Hello, Indianapolis. London. New York, Malaysia, Singapore, St. Louis. Paris. Hello, Alvar. Hello, Panama City. Rio, Sri Lanka. Hello, hello, Italy. California. Wonderful. Well, as you can see, we have people who join us from all over the world. One of the things that Emeritus is very proud of is that when we bring you these online courses, we have a global cohort. And so you'll be making connections with future friends and potential networking partners from all over the world. India, Hong Kong. All right. All right. So we're over a few dozen participants who have logged on today. So let us begin. Once again, my name is Mark Linehan, and I'm a webinar facilitator with Emeritus. And thank you so much for joining us on this informational webinar. So let's get started right away. If we want to pop over to the next slide, I want to introduce our fantastic course leader who's with us today. Nielsen Fields is on the line today. And Nielsen is a securities analyst at First Foundation Incorporated, and he is an expert in his field. And most importantly, he is one of our course leaders. This is one of the positions that we're really proud of here at Emeritus that really sets us apart from other online educational opportunities. We have these experts in the field that we have plucked from their sectors, from their industries, that work with our faculty and with our program support to give you an extra layer of support and help during these courses. And Nielsen's going to be able to tell you all about the course and what he does. But very quickly, I just wanted to wish a quick good morning, Nielsen.
Hi, good morning, everybody. I'm out in Southern California on the west coast of the U.S., so it's pretty early here at 6 a.m., but always happy to get on the call and introduce the subject matter. But just a quick background on myself. I've spent 8 years at a hedge fund in Southern California before going to Columbia Business School and then participating in the value investing program there, and took a class from the professor that you'll have, Tano Santos, and then now back in Southern California, managing on a team, managing an equity portfolio for high net worth individuals. So a lot of experience on the fundamental investing side, which is really where this class focuses. And this is, I think, maybe my 8th run as a course leader. So, and Leo, the other course leader, has done it more than a handful of times as well. So we have really good knowledge with the subject matter and experience running and conducting the courses and hoping and allowing you guys to get the best value out of it that you can. So really excited to be back.
Thank you so much, Nielsen. As you can see, he's an expert in his field and an expert in the course. So you are in excellent hands with Nielsen. Now, if we move on to the next slide, why come to value investing and who is this course for? So this course, we really feel that this is a really excellent course for a lot of different people to take, but the people that we're really targeting with this course is people who might already be investors or portfolio managers, which could mean people who do it professionally or people who do it on the side. There are lots of people who might have different careers, but you're online, you're on your lunch break, and you're watching what the stock markets are doing. If you're one of those people who always has CNBC going in the ticker in the background, this course might be for you as well. For people who are interested in understanding what the methodology is all about, to go beyond the information available in the market to uncover unique value opportunities, and being able to look beyond the market wisdom that is out there. And of course, you'll see we put wisdom in quotes on purpose. This course also delves into certain tools and frameworks that you can use. And this is also for people who are new to investing and want to learn how to invest. You do not have to come into this course already having a portfolio, already having an E-Trade account that's been burning up your laptop for years. Like if you're new to investing and you just want to learn, this is for you. This course is great for you. This course is also valuable for corporate decision makers at any level. As you can see, as we were talking in the chat box, you see we have a global diversity with our cohorts, but we also have a diversity of work experience as well. Your fellow classmates are going to have 1 year of experience, 25, 30 years of experience, 15, and all levels in between. So people of all corporate levels are going to be in your cohort taking this class. So, and we consider that one of the great strengths of this course as well. So corporate decision makers at any level, this will teach you analytical skills and be able to enhance your analytical skills. Learn when growth creates value, how to get beyond the hype, how investors are going to be thinking about growth versus value, and also being able to see your own business in a new way and also identify valuable competitive advantages. Now, before I hand it back off to Nielsen, who's going to take us through this amazing course, I want to quickly draw your attention to the bottom of the Zoom screen, a couple tabs over from where you saw that chat box. If you go a little more to the left, you're going to see a Q&A box. It should be a little white box with a Q in it. That Q&A, we're going to be devoting the latter part of this informational webinar for an interactive Q&A with Nielsen, which will be very similar to some of the what your relationship with Nielsen is going to be during the course, is being able to ask him questions and get feedback from him on a regular basis. So if you have any questions about the course, any questions for Nielsen, content, logistics, anything like that, please go ahead and while Nielsen is making his presentation, put that in the Q&A box. So then right when Nielsen is done and then I make my sales pitch, we can go right into a Q&A and answer as many questions as possible, because we never want anyone's questions unanswered. So make sure if you have any questions, thank you for people are still saying hello in the chat box, and that's what it's for. Please keep saying hello and checking in the chat box. But if you have questions about the course itself while Nielsen is presenting, I'm going to draw your attention to that Q&A box. And with that, Nielsen, take it away, my friend.
Okay, great. Thanks, Mark. So you're here because you heard of value investing, but why value investing? And up on the screen is just the performance of Berkshire Hathaway, which is the company Warren Buffett took over in the mid-1960s. And this is just the equity market returns and the book value growth of Berkshire Hathaway since he's taken over. And you can just see the power of compounding at a higher rate of return than the market and what that does to your ultimate endpoint in value. So book value is worth over $1 million. $100 invested in Berkshire Hathaway when he took over is worth like close to 2.4 million, but the book value is 1 million, and the market has returned you to under $1,600. So I'm sorry, $16,000. So the difference is quite dramatic. You can see down here on the bottom left that he's compounded at 19.1% and 20.9% on a book and market basis versus about half of that for the market. And by the way, his annual letter came out this past weekend. So if you're interested in getting the updated numbers, it's on the very first page of his annual letter. And you can find that on his website pretty easily. And I would say that's great reading to start off the course if you're interested. So the big takeaway here is that it works. And that's why I went to Columbia to learn more about value investing specifically. And this is Columbia. So Columbia really has a rich history of value investing. So on the right side, this picture is Ben Graham. And Ben Graham wrote with David Dodd, both at the time they were professors at Columbia Business School in the 1930s, the book on the right called Security Analysis. And that was really the Bible for fundamental investing. And Warren Buffett's business partner, Charlie Munger, calls all intelligent investing value investing because basically the premise is buying a stock for less than what you think it's worth. And anything else is, in Munger's terms, unintelligent. And really what Ben Graham would say is anything other than investing is called speculation and effectively gambling. But what happened in the 1930s is Ben Graham lost quite a bit of money in the Great Depression and thought there must be a better way to invest versus just listening to stock tips from friends or board members of companies. And so he really defined what is fundamental analysis. And fundamental analysis is looking at, your income statement, balance sheet, statement of cash flows to determine the quality of the business, the direction of that business. Is it getting better or is it getting worse? Also, how to determine value. You can do a discounted cash flow model, although we take a very different view. But basically getting down into the economic cash flows of this business, and we call it the earnings power value of a company. And that was really, I would say, what started Columbia off on this path of value investing. In the 1950s, Warren Buffett came to Columbia Business School specifically to study under Ben Graham. He then worked for Ben Graham at the Graham-Newman investment partnership, and then went on to start his own thing, which was the Buffett Partnership. He was buying a ton of Berkshire Hathaway stock, eventually closed his partnership, retained all the Berkshire stock, and that became his investment vehicle going forward. And he's just put up tremendous returns. Another professor at Columbia Business School is Bruce Greenwald, and he kind of reinvigorated the value investing program in the 2000s because it had died a little bit. But there's now an endowed chair at Columbia Business School. The first one was Bruce Greenwald, but then he has worked with Tano Santos for, I want to say, 8 to 10 years. And when I was going to Columbia Business School, the Value Investing with Legends class was co-taught with Bruce Greenwald and Tano Santos. Bruce Greenwald is now fully retired, and it's the Tano Santos show, and he is your professor for this course. So, and in fact, this course is nearly identical to the Value Investing with Legends course that I took on campus with Tano. And if you pair this course with the Value Investing Legends podcast that you can find online, that's almost identically to the full course that I took at Columbia, because the first half was all material, and then the second half was all guest speakers. And if you pair the two, that combines to become basically the course that I took at Columbia. But this is the course. our learning journey here will start with foundations, and that is basically what is value investing. We'll give you a little bit of search strategy, finding new ideas, where to look, and also give you the evidence to suggest and that supports that value investing works over time. It hasn't really worked in the last 10 years. In fact, going back to that slide with Buffett's returns, I think since 2010, he's underperformed, and it's the first time coming out of that period that he's ever underperformed on a rolling 5-year basis. And the reason is, in my view, interest rates have come down quite dramatically, and that supports growth investing versus value investing. Although you'll learn in this course that we don't think of those two things as separate investing styles, although they are quoted as separate investing styles by many market pundits. But we think they're attached at the hip. Growth is just a piece of the value equation. But we run through those foundations to begin with. And then we'll spend 2 or 3 case studies on valuation before moving on to strategic analysis. And strategic analysis really matters, particularly when you're dealing with a business that has the opportunity to reinvest its capital or retained earnings. So a company produces net income every year, and they have a few choices where to put that money. One, they can return to shareholders either in dividends or share buybacks. They can do an acquisition, or more importantly and more interestingly, they can reinvest that capital into their own business. And when we're valuing growth, we really need to understand the competitive landscape and the barriers to entry and the competitive advantages that business has in order to retain that attractive opportunity. And so we talk about that analysis there before moving on to valuing growth, because without sort of that competitive advantage, the value of growth basically gets reduced to zero, because competitors will come in and compete away your growth opportunity. And then finally, we talk about risk management from a macro perspective down to the micro stock specific level. And then we finish that all off with a case study, and we use John Deere as our case study, but that will take you from, well, it doesn't quite cover the search strategy, obviously, because we're giving you the name, but from step 2 all the way to step 8 in the process. So this is a chart that you'll see often throughout the course, but this is kind of in another way, a roadmap for the course. And this is outlining our 3 different valuation methodologies. The first is asset value. It's the AV. The EPV is earnings power value, and the FV is franchise value. So over the course, we move from asset value, earnings power value, and franchise value. And there's specific indications that you get when you value a business on all 3 of these levels. And the information that you get from where they lie relative to each other is important. And it comes down to the competitive advantage that the company has. And if there's no competitive advantage, you're probably just looking at asset value or earnings power value. If asset value is above earnings power value, then there's something with the management team that isn't, I would say, using those assets as efficiently as possible. And so it's kind of an interesting way to kind of lay out your cards for the company and see where the value lies in each of these and the signals that you get from both those. And then, of course, one sort of tenet of value investing is operating with a margin of safety, meaning if you think that the earnings power value is, call this 100, well, then you don't actually want to buy the stock at 100. You want to buy it at 80 or 75 and leave yourself room for error. And that's your margin of safety. And so we just think this is a really good map. Basically something to keep coming back to. And it's a very useful imagery of how we think about investing. But just quickly going through highlights of the different modules here. The first module, the value investing framework, and then working on asset value. But you know, 8 or 6 tenets of value investing would say it requires looking at ugly and despised firms, and that's because we don't want to be hunting where everybody else is looking, because that's hard to find sort of overlooked and underfollowed businesses, right? And if you look where things are ugly, that means that those businesses have been left for dead. And if you can find a business that in fact isn't dead but has been left for dead, that might be a big opportunity. Value investing requires when and where nobody is, right? And so it's kind of the same thought process, but we use a case study of Magna International in March 2009, and it was a car-related business, and nobody wanted to invest in that industry, but it turned out extremely well, and we'll walk through that case study. It requires patience and inaction. I think it's kind of funny. The more successful investors out there will say buying is the easy part, selling is the hard part. And what happens with too many people is that they actually find a good business, they buy it, but then, you know, they make 25 or 50% and sell it and move on. But in fact, that business goes on to do incredible things, and you've missed out on a huge opportunity cost. And in fact, Buffett has talked about that before too. He had owned ABC Capital Cities, which was acquired or merged with Disney, and then he owned Disney shares, I think in the 80s or sometime, and sold those way too early. And those would have been, that was a big mistake of omission by selling those and not owning Disney. So patience and inaction are important here. And it requires, you know, holding positions for an extended period of time, low turnover, kind of similar thought as the prior tenet. It requires holding cash in the presence of a roaring market, meaning if valuations are so overextended that you can't find anything interesting to do, well, then it's okay to hold cash. And that's sort of your ballast, if you will, or your hedge, in that you don't want to be investing in areas where valuations are extended, because that could kill your future potential return if there is multiple compression, right? And that clearly happened in the 98, 99 timeframe with the tech bubble. Buffett was basically out of the market for a while, not investing. And the day the NASDAQ peaked was the day that Berkshire Hathaway lowed in late 99 or early 2000s. So, you know, things were at their worst for Buffett when things were at the best for the market. And those two things dramatically turned around and went the other way for 9 years. So, you know, you can't be afraid to zig when the market's zagging, is the idea. But then most importantly, and I would say this is all investing, not just value investing, but it requires discipline and humility, because I think the best stock picker is going to be wrong a third of the time or more. And knowing when you're wrong or the market is wrong is important. And I think you get there with just a certain number of at-bats and practice and doing this live with real money. And so, you know, you've got to have there's a certain amount of arrogance, but mixed with humility to say that, I have a variant view versus the market. My opinion is X, the market opinion is Y. I think X is correct based on my research. But then over time, if X isn't playing out the way you thought it would, you've got to have humility to move on and admit that you're wrong. And that's very hard for people to do in the investing industry because we're all type A personalities, right? And nobody wants to look like they're wrong. And then you have to be constantly reviewing your process and getting better because investing is a relative game. And if you're not improving, somebody else is, and that means on a relative basis, you're getting worse, right? And so you've got to keep improving your own process. So just quickly on the further modules, we talk about earnings power value using a company case study called Hudson General. And this is a little bit dated, but actually that's okay because if we constantly had to keep new examples coming, that means that the lifetime value of the lessons that you're learning are short. And so if you can look back at the 80s and say that the concepts still apply, that's really good, right? Otherwise, the depreciated life of your potential investment in this class is really short. But we want to be teaching you lessons that will last a while. And of course, things tactically change, but strategically, we think value investing has some tried and true principles that you'll learn in the course. But this is just a quick example of Hudson General in calculating earnings power value. And then in module 3, we talk about strategy. And this is actually my favorite module because it's more qualitatively focused than quantitative. It seems like the quantitative aspects of investing have gotten more and more efficient, but qualitatively, I think there's a lot of uncovered value and lessons to be learned. And so this is certainly the most qualitative aspect or module in our course. And we talk about competitive advantages and the different types of competitive advantages and what it means to have one and why it's important for a business to have one. So my favorite module, module 4, this is the Magna case. This is the auto manufacturer, not the auto manufacturer, but a supplier to auto manufacturers. And of course, we looked at that in 2009. And this is annual sales of light trucks and autos, and you can see that they're just falling off a cliff. It is very hard, and also GM and Ford and Chrysler were all going bankrupt at that time, so their customers were potentially going out of business. And this was an example that Bruce Greenwald had pitched to a fund that he was advising for called First Eagle at the time, and it worked out very well for him. But that was an industry that was under a lot of stress and turmoil, and he was willing to go look in that area for something perhaps really interesting. Module 5, we talk about growth and value and what that means. And this is, again, here's your look at asset value, earnings power value, and franchise value, and when valuing growth is important or not, and how we look at that. We look at the franchise value a little bit differently than asset value and earnings power value. So we think about franchise value in return space rather than putting a certain dollar point estimate of intrinsic value. And if you look at the really good investors, this is how they think about growth investing, meaning, company A is producing 5% free cash flow yields, and that's all coming back to shareholders in dividends and share repurchases. They can grow their business organically 4% on the top line without much reinvestment. And with operating leverage, that gets them another 2. So you're at 11% total return on that investment. And you then compare that 11% to your cost of capital and determine whether or not you think there is an attractive investment opportunity. So that's how we incorporate growth, and it's a lot different than the market typically looks at growth investing. And then module 6, we look at Amazon, which could be, the ultimate growth company, but it's a really interesting case study because we think about Amazon, a lot differently, and we think about whether or not that growth is coming in areas that have competitive advantages or not. And so, this slide is just showing how large Amazon is relative to eBay, Walmart, Apple, and Home Depot, the other large online retailers, and Amazon just dominates those. But, they operate in different businesses. And so we kind of go through whether or not Amazon has competitive advantages in those different businesses and whether or not that growth creates sustainable, I guess, intrinsic value growth rather than just, top line growth. So module 7, the penultimate module, is about risk management, and we take a wide lens and narrow that down to the company. So the market and the economy. Talk a little bit about monitoring, hedging, and different asset classes. A good example here is Buffett yesterday morning had a 3-hour interview on CNBC. You can go to cnbc.com and find the entire interview online if you wish, and I'd recommend it. But Becky Quick asks him about how are you thinking about coronavirus in your own investing actions, today. And his answer was basically, I can't control coronavirus, and it's certainly not going to change how I view a business 5, 10, or 20 years out. So it really doesn't change my mind much. He said we're definitely not selling, and he wouldn't say if they were buying yesterday or not. But that's, the typical value investing mindset is to focus on the things that the company can control. And from a macro level, things are generally out of their control, but clearly it matters in some industries. So if you're looking at an E&P company, exploration and production, where their main product that they're selling is oil, you've got to understand what a change in oil prices do to the income statement and balance sheet of an E&P company, right? And so that's on a macro level. So on a portfolio level, we also talk about position sizing, hedging out specific risks within the portfolio that you see that might not be what you're after. So for instance, in John Deere, we talk about hedging out some of the commodity risk in that way and how to do that. And then on a stock specific side, that first bullet point there, you see the margin of safety. And that's just, what I touched on earlier, where we don't want to buy $1 for $1. We want to buy $1 for something less than that to give yourself a margin of safety. A pre-mortem is something that's been popularized over the last, I'd say, decade. And that's basically saying, okay, we're going to buy this today, but let's write out our how this didn't work out case, right? And this comes from doctors who do a post-mortem on a surgery, and they talk about what went right or wrong in that surgery. But with our pre-mortem, we're sort of making up reasons or fantasizing about how things didn't work out. And that really can change your mindset and help you focus on the downside and just make you aware of the potential risks. Because sometimes you can get so excited about a business that you choose to ignore the information that might disconfirm your thesis. So you want to be open to those things, and a pre-mortem helps you do that. And then your investment horizon. Another professor at Columbia likened investing to a tennis match, and you never know who's going to win a certain point or game, but you know that a better player is going to win more sets and ultimately the match. And so as you lengthen your time horizon, the more the skill of investing plays out versus the luck of investing. And clearly there's luck involved in investing, especially as you shorten your time horizon. And you know that luck is involved because you can't lose on purpose. And losing on purpose is actually just shorting. So if you thought you could lose on purpose in investing, you should just become a short seller and pursue that strategy, right? And then you would make money. But even the best short seller out there, Jim Chanos, his returns aren't that great, and it's more of a different risk profile in his investment strategy than you're getting anywhere else. And so, you just can't lose on purpose investing, and that means luck's involved. And if there's luck involved, that means you want to lengthen your time horizon to ensure that more of the skill of investing weighs on the outcome than the luck. And then finally, we wrap it all together with a case study on John Deere. And this takes you through all the modules that we went through and incorporates all of that for you. So, and I think you get 2 weeks with this module because we found that students like the extra time because there's a lot to wrap your arms around with John Deere. So that's the modules. Some other program highlights. There's 175 videos, and actually they've improved the videos quite substantially over time. You can now change the speed at which you watch the videos, and there's also subtitles, which is helpful. Tano has a Spanish accent. It's something you get used to over time, but in the beginning it can be a little bit challenging to understand, but you can always rewatch the videos, you can change the speed, and now they have subtitles, so it's really good. There's 8 exercises throughout the course, and the 8 case studies that I just went through. Here's just a sample of what a video looks like. He's in different locations around Columbia. It's kind of funny watching him. Remembering all these locations, but this is Tano for you. And then here's just a sampling of the case studies. Walmart is a big case study running throughout the course. There's just a lot of information available on Walmart, and Tano likes to use that example because of that. We also talk about Intel and Nestle, but these are all businesses that you know and have heard of, use their products, and so you can relate more easily to these case studies than you otherwise would. And this is just a sample of one of those exercises, and it's there to reinforce what we just taught you in some of the videos. And Tano has created this Santo Sangria to, it's his fake business, it's a wine business, and they're just little examples of our exercises to help you continue your learning process. And then additionally, 2 big things. We have discussion boards, and those are useful in that you can get online with your fellow classmates and pose questions and or offer up different subject matter to discuss with your classmates. And your course leaders will be on there facilitating that discussion. So I'll be on there answering questions that remain unanswered from your classmates. And it's really interactive. We think a lot of students get a lot of use out of that. So that's a great resource. And then additionally, we do host a live office hour once a week for an hour it's usually about this time, same day. And currently we have a run going on right now, and Leo at this moment is hosting an office hour for the current run. So I do 4 and then Leo does 4. And it's really something that students get on and ask questions that they still have from that course material, or even, other just general investing questions. And that's one thing that students have continuously said they liked about the course. And then finally, before I hand it back over, we walk through an additional example in those first 4 office hours. This is a company called Ball Corporation, and we heard from students that they want more examples. And so this is an example that I put together that is currently a live investment for us at First Foundation. It was actually the first company that I pitched and recommended and that we bought when I came to work at First Foundation. And I think it highlights very well all of the different valuation methodologies and the strategy module extremely well. So I covered that in the first 4 office hours, including taking questions from you guys on the modules as well. So very useful in our opinion. But Mark, let me hand it back to you and let you tell the participants what other students have said about the course.
Nielsen, thank you so much. I can tell you right off the bat that was a highly successful presentation because the Q&A box is blowing up. So we have lots of great questions from our amazing future students. So I'm going to keep this as quickly as possible, just talking about one question that actually has come up in the Q&A is, what can I get out of this course? What is this course going to look like? And I think the best people to answer that questions are people from previous cohorts. So right here on your screen, you can see 3 different testimonials from an owner of an investment firm, an investment analyst at a fund firm, and a managing director overseas. And so you can see that they all got different things out of this course. Craig Kelly says the program helped me understand a new way of viewing investing. Britton Sorensen says that the best part was the dialogue between classmates, myself, and the TA. I'm going to talk a little bit about that on the next slide in a minute, but one of the things we're really proud of here at Emeritus is that we've developed courses where you're learning just as much from your fellow students as you are from the faculty, and the international cohort and the breadth of experience that you're going to get from your fellow classmates is something that we are particularly proud of. But also, as Kirat Modi says at the bottom, the best part of the course for me was the diversity of cases discussed. So regardless of what kind of industries you're looking at investing in, we're going to be giving you all sorts of different examples and not just one case study. We do have that one huge capstone study that Nielsen talked about, but you're going to be looking at many different examples and many different ways of applying what you're going to be learning here. So on the next slide, one of the things that I do want to talk about is the participant profile. We've already mentioned how we have a global diversity. We also have talked about how we have a work experience diversity. Everyone from 1 to 35 years of experience, 40 years of experience are going to be in this course. But we also have a lot of diversity by industry as well. So as you can see, while banking and financial services do make up a plurality of the industries that we work with, which makes sense, it's an investing course, but we also have healthcare, real estate, consulting, industrial goods, energy, education. And if you look at that bottom bar, it says others. That covers everything from human resources to tourism to agriculture, civil construction, advertising, e-commerce. So as you can see, you're going to be talking about investing and learning about investing with classmates that come from a diverse set of backgrounds. And that's also going to help you learn new ways of thinking. So very quickly, again, we have a lot of questions that we want to get through. So I want to just burn through some of these testimonials very quickly. One thing that a lot of people love is the concise nature of the videos. Like Nielsen said, we have 175 video lectures. So whereas some online courses, you have to find an hour and a half in your day to sit down and watch a video on your home desktop, this is bite-sized learning. So it's the kind of videos that you can cover lectures while you're commuting. If you have a train commute of 30 minutes each way, that's anywhere between 6 and 10 videos that you can burn through on while you're commuting on your way to and from work. So we really try to make it so that this is the most flexible style of learning that we can possibly give you. So the presentation of the materials is very simple. It's easy to follow, not oversaturated with technical terminology. The material is very practical and not theoretical. So we're going to be covering some concepts as well, but we're not here to necessarily learn theory. We're here to teach you something that you can apply to your own investing and to your own company. The next slide. Oh, thank you. Nielsen is reading my mind. I don't even need to say anything. The Nestle exercise forces us to understand the brands and how to evaluate and review barriers to entry. Very helpful to have an explanation video following the exercise to clarify and solidify ideas for completion of strategy. Next slide, you'll see I really liked how the examples brought the course material to life. Clearly explained. I feel that I have a firm grasp of the subject matter. And this is a question that has already come up in the Q&A. That is the first question I'm going to be asking Nielsen in a moment or so, is about how much do you need to know? What are the prerequisites of this? How can I have a firm grasp on these concepts and apply them if I don't have a background in investing? And as you can see, past participants who don't have a background in investing have felt that they have a firm grasp on the material. The exercises, although simple in nature, really taught you to think beyond the quantitative nature of evaluating a company and look at qualitative items with great importance. So do not be fooled by the simple nature of the exercises. This is an in-depth course. You are going to be learning a lot on this course. And what we have next. So next steps. Your next step is right now, program support is popping up a link in the chat box. So if you return back to that chat box that we used at the beginning of the webinar, you are going to be seeing a link popping up. There it is. Click on that link right now. This course starts on March 11th. I know you might think to yourself, great, that's more than 2 weeks away. I'm totally fine. I don't need to think about it right now. Those 2 weeks in anyone's life can fly by in an instant. So click on that link. If you would like a recording of this webinar, or if you would like the slides to be able to go over them on your own, click on that link. If you want a program advisor to take you more through the course and answer more of your questions on the logistics, click on that link. Or if Nielsen sold you, you have heard everything you need to know. Value Investing Online with Columbia Business School is exactly what you were looking for. Click on that link. It starts on March 11th, and I don't want you to miss the opportunity to take this course. So make sure you click on that link, or at least just keep the tab open on your computer like I do. I'm one of those 500 tabs open on my desktop at the time. Make this one of those 500 tabs that is open. And now, while we still have some time left, I want to go through these questions because you have asked so many wonderful questions. So very quickly, Nielsen, the first thing I do want to ask you is how are people going to be able to learn high-level analysis if they don't have a background or an understanding of accounting, finance, and economics? How do we give them such in-depth coursework if there are no prerequisites?
Yeah, well, one thing we've done in the past is suggest to enrolled students who do need some accounting background, and I'm not even talking anything really meaty here, but just a quick understanding of how the income statement works, because you kind of need to know what operating margins are and what a balance sheet looks like, because we are going in and out of the balance sheet to find information in the annual report, for instance, to come up with our asset valuation. And so I think people get the learning curve if you start from zero is it's not difficult there to get there, but it's very steep, right? So you learn a lot. And Tana's literally walking you through the first few times where to find this information. And if something's confusing, we've gotten a lot of student questions about where do you find X figure, and we're there to help you, right? On the discussion boards, you post your question, Leo or I will kind of hold your hand to get there. And then you clearly have the other students to ask and help others as well and support them. But there's a community here that is going to help you. And one thing that we've done after the first few runs is segment participants into different groups, 2 different groups based on their investing experience or their accounting experience. And so you do take a pre-course survey where will determine whether or not you should be in bucket A or bucket B. And in bucket A is people with similar and close relative experience with financial statements, accounting, investing, etc. Maybe less experienced. Bucket B will be the more experienced group. And so we found that that helps quite dramatically in the experience for students, because it degrades the experience if somebody's on the discussion boards talking about very basic accounting questions with somebody who's very knowledgeable. They're not getting the most use out of that discussion board. So when we grouped the two, it made a huge impact to the positive side.
Thank you, Nielsen. We also had a couple questions on the opposite side. We had many questions about there are no prerequisites. What do we need to know? But on the opposite side, we also have a lot of questions about, okay, I've read these books, and if you've already read these books, what more are you going to get out of the course? Me personally, I would immediately say the discussion boards, the back and forth of the course leaders, the program support, and the incredible international cohort we have. But Nielsen, what more can we get if we're someone who has read a lot of these books? What are we going to get if we have a little bit more advanced knowledge? What can we get out of this course?
Right. Well, two would be the live office hours, right? You're not going to get that elsewhere. But I would say mainly, I've read investing books several times, and each time, because I'm in a different arc of my investing career, I get something different out of that. And so I think if you've already read Value Investing, I think it's From Buffett and Beyond. That's one of Greenwald's books. And then Competition Demystified, that's another one of Greenwald's books that we recommend. You're going to get something different out of it because you're in a different place with your investing career. And the concepts might hit you differently. It might be a different note or whatever, but I still think it's useful, even to those who have read the books. I read all the books before going to Columbia, and I got a lot of use out of the value investing curriculum there. And then additionally, we do have just an enormous amount of additional resources that Leo has put together. It's just an incredible treasure trove of information that goes beyond the books that you're referencing there. And they include other books, but also different papers written by practitioners and professors at Columbia. So this is an enormous amount of resources that Leo put together, and it's pretty incredible, to be honest.
Thank you, Nielsen. We have a lot of questions about, which again, the curiosity on the Q&A is incredible, but we've gotten several different questions that have been based around different kinds of investing and how value investing is different. So can you talk about value investing as compared to growth and momentum investing? We had another question about technology investing and whether that is a subset of value investing, comparing value investing to investing in an index fund. So just the basic definition and the term around value investing compared to other kinds of investing seems to be a hot topic.
Yeah, okay. So value investing is, at its simplest form, you go out and you value a business based on different metrics. Traditionally, that's been the future cash flows of the company. Those are discounted back to the present value to find the intrinsic value of that business. And the goal of value investing is to buy that business for less than you think it's worth. Other types of investing, so in that valuing those discounted cash flows, growth is incorporated in that process, right? And even in our franchise value calculation, we're including some level of organic growth. And so the the debate around growth versus value in our minds is a little bit, I guess, disingenuous or incorrect, because, you know, as a value investor, I would like to have a business that's growing its intrinsic value substantially, right? The challenge is that most businesses that are growing are valued so richly that you are running the risk that multiple compression will hurt your future returns. And so I was just answering a question on a discussion board from our current run about a student asking, what do you mean about multiple compression? Well, in 1998, Coke, which is an exceptional business, had still growth opportunities in front of it, was selling at an extremely high multiple, and I think it was 40 or 50 times earnings, but on average, it's probably closer to 20. And so over time, even though earnings grew, right, the multiple compressed and you were left with a mediocre or worse return. And so I think growth investors don't really consider the risk of multiple compression. Momentum investing, I would say, is just buying whatever's worked and assuming that will continue. And in that case, you're looking at more crowded areas of the investing landscape, right? And it might be true and it might work that they'll continue to work. But again, with momentum investing, if everybody's crowding into this one area, that means that multiples are probably going to be high. And Michael Mauboussin, who's a professor at Columbia Business School, has been teaching the security analysis class for, I think, 27 years. He's written about the fact that a market's a complex adaptive system and it's fairly efficient when everybody has different opinions. But when those opinions coalesce around one opinion, that creates inefficiencies. And if you're talking about momentum investing, that means that you're doing the same thing that everybody else is, right? And I think that's an inefficient area, especially if you're looking for the long side. It might be interesting for the short side. So I would say, those are some of the differences between value investing and growth and momentum. In terms of like ETF investing, those are basically a collection of businesses. You know, the most common ETF is probably one indexed to the S&P 500. And in that case, you're effectively buying 500 businesses. Some of those are really good businesses and some of those are businesses that you don't want to own. Some of those are really good stocks to own. Some of those are bad stocks to own. So with value investing, we're trying to focus on the fundamental analysis of each individual company and having a deeper understanding of the mechanics of that business. Whereas if you just buy the ETF of the S&P 500, you don't really know much about those companies in that index. And certainly there's nobody there besides the one guy that determines the weights and the companies within the S&P 500 that, really understand. And I would be surprised if he really understands all the mechanics of all the businesses that are going into that index, right? So we manage a portfolio of 30 companies because that in our mind is, and we have a team of 4, right? So Charlie Munger has 4 personal positions that he has. And so value investing is much more concentrated. And Buffett always likens it to, why would you buy a business, your 20th business in your portfolio, if you already like the 19 ahead of it, right? Maybe just add money to the 19 because you're sort of diversifying your portfolio by buying your 20 best idea rather than continuing to put money in your top 5 ideas, for instance. So.
Thank you so much, Nielsen. I mean, and thank you for answering. I know I threw like a very broad question at you, and then you ended up going into more than I even asked you to. So thank you so much. Like what Nielsen said, many of you have asked about this. Like you are going to be getting the knowledge and techniques to put into practice. Like this is not a theoretical course. Like what Nielsen said, like we give you concrete examples. You're going to be able to systematically find and seek out those undervalued companies to potentially invest in. And very quickly, Nielsen, because I think I only have time for like one more question. We had a couple questions that talked about value investing in the past decade. So as the stock market has skyrocketed, it's been a bit more volatile in the past couple of years. But as the stock market has skyrocketed, like where is value? We will be looking at historical examples, but can you speak about value investing specifically in the past 10 years or so?
Yeah, no, it's definitely been challenged. And I mentioned earlier that Buffett's underperformed for the last 10 years. And it seems like over the last 10 years, the being burdened by the fundamental analysis has been a challenge, right? Because some of the best stocks out there have been the best stories, right? So Tesla, I think, is a great example because from one end, Tesla's a great story. They are producing electric vehicles. They're beloved by the buyers of those vehicles. There are fanboys of Elon Musk, similar to fanboys of Warren Buffett. But so the longs want to buy the stock because they love the story. On the short side, people who have done the fundamental analysis, have questions about the viability of Tesla as a business model. And for a while, every car they produced was making them negative money, right? And so anytime they produced a car, they were losing money. And in fact, I think the best sort of example is not example, but sort of a key thing with the Tesla story is Elon Musk himself said, we were 2 weeks away from bankruptcy. And I think he said that about this time last year, or maybe it was 2 years ago. But to be owning a business that you don't know much about the fundamentals, but you like the story, and to have the potential for that business to go bankrupt in 2 weeks, you're just not doing the fundamental analysis that we think is required in investing. And you were taking a lot of risk in that sense. But they have survived, and that stock has gone from, say, $150 to $800 in a matter of 6 months. And so that's a pretty incredible turnaround for the stock. I still don't think the business is performing to that level. But it seems like those story stocks have worked over the past decade. And my opinion is that those story stocks have worked because interest rates have gone down, and borrowing money to continue to run your business, perhaps at a loss, or get additional VC funding has never been easier. So you can amend and extend your credit terms, or that's effectively kicking the can down the road and surviving a little bit longer. And secondly, value investing sort of focuses more on current cash flows because those are more certain than distant cash flows. But if your discount rate that you're discounting those cash flows at continues to decline, that means the value of those future cash flows becomes higher and higher, right? And so the value of those future cash flows makes up a larger portion of your intrinsic value as interest rates fall. So growth investing, or like technology investing, cash flows are coming further out in the future, and lower discount rates have made those future cash flows more valuable, and that's helped the growth side of the investing landscape.
Nielsen, thank you so much for that. And thank you to everyone for joining us today. Unfortunately, we are out of time. But if you have more questions, please send them to columbia@emeritus.org. Again, please focus your attention on that chat box. Click on that link if you have additional questions, if you need a program advisor, if you are ready to sign up for this course right now. You can hear what an expert Nielsen is in this field. Please sign up for this course. You can click on that link in the chat box. I want to thank Nielsen Fields so much for taking us through the course today and answering all our questions. Thank you so much, Nielsen, and have a beautiful rest of your day on the West Coast.
Yeah, thank you, Mark. Appreciate it.
And thank you all for joining us today. We're so thankful you joined us, and we look forward to seeing you in the classroom. Have a wonderful day, everybody.